Morning, everybody. I hope the technology works, and I hope you all enjoyed your coffee break. I do have a slide later on that will make you feel a little bit guilty about that. So as Darren said, my name is Paula Thornton. I work as a pension consultant at CPAS, and CPAS are the pension specialists for the construction sector. So the title of my presentation this morning: Are your pension savings adequate? During this presentation, I will take you through the reasons why I think you should save for your retirement. I will also take you through a recent CSO study and the results of that as to who are saving and the reasons why part of the population are not saving. I offer some solutions for the people that are not saving. And the final answer, I suppose, to all our questions: how much do you need in that pension pot? So, why save? I have subtitled this slide, The Scare Tactic. So this is basically to encourage everybody by facing some of the realities of what will be provided for you in retirement if you don't save. Life expectancy is a very important element of pension planning. Most of our people that come to retire at 65 expect to live for 20 years, so that is a good innings. But just I have a figure there of 150. Actuarially, our actuarial people would say that the first person to live to 150 has been born. We may even know them. So if you're not on a good pension, it's a long time to live on a very meagre income. Speaking of meagre incomes, the state will provide you with an income in retirement. That is currently €233.30 per week. A welcome €3 increase there in January 2016. However, for a lot of the population, that will be a big drop-off in income between your pre-retirement and your post-retirement income. Also, a worrying fact that maybe some people don't appreciate is the number of workers that are currently working to fund this state pension. If you're not aware of it, the state pension is funded on a pay-as-you-go basis. So basically, all the pension money that goes out from the state is paid out of taxes that they take in a current year. At the moment, there are 5 people working for every pensioner. So you can see they have a lot of tax take to pay out those pensions. However, back to the statistics and the projections and our actuarial friends again, by the year 2050, we are only expected to have 2 people working for every person that's retired. I think that's quite straightforward to understand that that level of state pension is unsustainable. And that leads me nicely to my next point there, which is an estimate of what the industry feels is the state funding deficit, €440 billion. You didn't hear that when the TDs knocked on your door for your votes there a few months ago. There is 2 elements to that. One is the cost of the pay-as-you-go social welfare system, but also the cost of public service pensions, which are also on a pay-as-you-go basis. Now, we did have a pension reserve fund, you might remember that, but unfortunately that is all spent. So something will have to be put in place to cover that. Some of the options are for the state to increase the state pension age. They have done this. Currently it's 66. By the year 2028, it'll be 68 before you can claim your state pension. However, the feeling is that that actually might have to be pushed out beyond that time. The other option is for them to increase PRSI contributions to actually fund this liability. Again, not a popular option. And the third choice they have is to reduce the state pension, which they have been doing by stealth over the last 6 or 7 years by not increasing the state pension amount that they have been paying. So they're the stark choices facing the government. For us personally, our choice is to make our own provision and to save for those benefits. But unfortunately, there is currently less than 50% of the population that are saving for their pensions. I will take you through how that is broken down in the population. And I suppose the bottom point there I make is that pensions are expensive. If we go back to the point one of how long people are living, obviously if you're guaranteeing a pension income for someone for life, that potentially will be for a long period. And we are currently living in a low interest environment, and hence with low bond yields, the cost of buying a pension has increased substantially in recent years. Just to give you, I suppose, a feel for that, when I started in pensions, and that was not yesterday, you could have bought a pension for every €1 pension, it would have cost you €9. That statistic is currently for €1 of pension will now cost you €25 or more if you want some fancy indexation or a higher spouses or a higher guarantee. So that's the development in recent years, but not necessarily very recent. So I will take you through the CSO results. The CSO published a study at the end of May based on a household survey that they took in the last quarter of 2015. The last period when we had comparable statistics was 2009. So I have just summarised those. There was a lot more answers to those questions, but I think the stark summary is the drop off from 2009 is in blue. In 2009, 51% of the population had a private pension. That is now reduced to 47.1%. I think it is understandable when you see what has happened to the economy in the intervening period, but it is a worrying statistic that fewer people are actually providing for their own benefit. The second group, I've put together a few statistics and I've labelled them the relying on the state, so they accept the fact that they will just purely rely on the state pension, and the people that don't know what they're going to live on in retirement, and effectively, well, if they're not saving, they are going to be relying on the state pension. So that percentage has increased from 34% to 44%. And I suppose some people might have had plans maybe to sell their business, to sell their farm and use that as their retirement income. However, those plans might have changed in the last 6 or 7 years due to the recession. The last line there is people that are still confident that they have enough money saved, or like that they may have a business to sell and they are happy, and they're 8.9% of the population are fairly confident that they can support their own retirement. In 2009 that was 15%, so a fewer portion of the population have enough money put by for their retirement. Just a little focus on the construction sector, because obviously at CPAS these are the people that we deal with day in, day out, and this to me is a particularly worrying statistic. Employees in 2009 that were covered for pension was 44% of the construction sector, so a little under the population on average. Now we all know and have probably got personal experience of what has happened in the industry since 2009. But in 2015, only 34% of people working in construction are saving for their retirement. When we looked at those statistics in 2014, I would actually say they were lower, because we have actually in CPAS seen an increase in people saving for their retirement in the last year. So that is a positive. We do see the trend going back up when people are making savings. And one of the points I've made there, I've mentioned the impact of the recession, but I've also mentioned the change in employment status. And what we are seeing is employees are no longer directly employed, and there's a higher portion of people that are self-employed in the industry. And I think when you're self-employed, you're probably more concerned about your bottom line and your income, and less concerned about your saving for future retirement. And I think we just need to get the message out there that whether you're employed or self-employed, the state will do a certain amount for you, but you do need to take personal responsibility for your own income in retirement. So the survey kindly asked people why. And for those of us in pensions, nerds as we are, we found it very, very interesting. And the highest portion came back with can't afford. So again, back to people seeing a decline in their overall net income. The second group I've put together, I've called apathy. And these are the people who just haven't thought about it. And also the people who stated that their employer doesn't provide a pension for them, so they're not going to do it. And I put those in the same group because really they do need to take responsibility and think about it themselves. I know it would be great if the employer was paying contribution for you, but if there is nothing in place, you do need to look at putting something in place yourself. There's also a large group that I've called adverse. These are people I would class as risk averse. They might be afraid, they've heard some horror stories about Joe who lost all his money, and so therefore I'm not going to do that because I'll have nothing left. Or basically this lack of trust for pensions people. And hopefully in my solutions I'll offer some comfort in that. And then we've got the little cohort down the end who have got other sources and potentially might have had an old pension scheme that will be sufficient for their income, or they're content if their spouse has a pension that they will be provided for in retirement. So it's easy listing the problems. Now the solutions. So the cannot afford. I can understand that after you pay your USC, your taxes, household charges, dare I say water charges, insurance, which is going up all the time, the amount left to live on week to week, it can be really a struggle. However, the benefit of pension savings is they're usually deducted from your salary before you get your net income. So it's a little bit of a challenge then, really just to live off your net income. And I suppose that's one way pension savings helps, because you get tax relief at source and therefore you don't actually see the amount going out and you do have to survive on the net income. The next point I've called the latte habit, and I have a separate slide just purely on that one, but it's just to demonstrate the benefit of saving a small amount over time and how it will all add up. And for the people that cannot afford to save, I would pose the question, can you afford to live on the state pension alone? And I think for some that will be a difficulty as well. For the ones I've classed as being apathy, the pension industry needs to take a lot of responsibility. We need to simplify the message. It is simply just saving for your retirement and receiving tax relief for those savings. We need to engage more with our members and take feedback. We need to dispel some of the myths. Everybody knows somebody who might have lost money, but do they remember the person who's done really well out of it? And maybe we need to tell some of those good news stories about the people who are actually comfortably living in their retirement. Another myth, a common thread I get from a lot of members, sure, I won't be around to collect that. I'm not going to live long enough. I'm glad to tell you all the vast majority of people in this whole arena today will live long enough to collect your pension. There will only be a handful that will not survive to 65, and for those handful we will look after your family if you're in a pension scheme, because usually we have some form of death benefit, or you will get back your pension account, your family will anyway, so there is some comfort there for your family. I think we need to clarify the incentives. Tax reliefs in pensions are better than the tax reliefs that were given in SSIAs. If you remember those, everybody understood those very clearly. But if you're a 40% taxpayer, pension incentives are actually better. We possibly don't make that clear enough to people, and there's a lot of work to be done around our communication and getting out and talking to people about this. Do we need to set goals for people? So give them a target, maybe give them a bonus at a certain point in time if they reach those targets. Maybe allow some early drawdowns, early withdrawals. I mean, the one thing that does put people off saving for retirement is the long-term nature of it. And by having to wait till 65, maybe we should offer something, an earlier drawdown at earlier stages, and make that something that makes pension savings a little bit more attractive. Another challenge for us in the industry is the trust word. Those of us who work in the industry, we understand the concept of risk versus reward. We need to take some amount of risk if you want to get good returns over the longer term. And maybe, as I said, we need to shout a little bit louder about those good years. It's human nature. We all remember the bad. I've given the second line there, the return on the Standard & Poor's over the last 10 years. On average, that's produced 5.3% per annum over 10 years. So we're going back to 2006. Everybody will remember 2008, and that's when the stock market lost 37%. That loss is in that 5.3% per annum figure. So remembering the bull run that followed for 6 years, where markets went up and up and up, I think is essential. And we also need to communicate that to people. Again, pensions, long term, 50 years. Not unreasonable that you could be saving for your retirement and after your retirement for a period of 50 years. If you are, the Standard & Poor's also returned 5.4% per annum above inflation over a 50-year period. And I haven't just selected a date. I've gone into the Standard & Poor's website, hit the end of the year and gone back 50 years. So I haven't tried to manipulate the figures in any way. That's just a reality of what the returns were. So this was the latte habit I spoke about earlier. Now this video, I'll be perfectly honest with you, it's not ideal. It is American. It talks about dollars. It talks about lattes. But it might just give you the idea of why and how long-term savings can add up over time. Also free advertisement for the Tinkham Financial Group.
The latte habit is a story about how little things can add up over time. In this example, our friend loves his lattes. In fact, every day on his way to work, he stops to get a latte. And on his way back from lunch, he gets another. The lattes cost about $3.50 each, which means he's spending $7 per day on his habit. That's roughly $152 per month. Let me introduce you to the $120,000 latte. If our latte drinker decides to invest the same $152 per month into an account earning 7%, at the end of 25 years, he would amass more than $120,000. So if our friend got into the habit of investing the amount he's consuming in lattes, he might be able to accumulate a sizable sum over time. Now, nobody is telling you to give up lattes, but little things can add up. And as this example shows, it doesn't take much effort to accumulate money if you have the discipline to save and invest consistently.
Okay, so a few things not great about that example, apart from the fact that it is Americans based on dollars. 120,000 actually won't be enough for your pension. But again, we haven't taken into account tax relief, and we haven't taken into account the other elements of pension savings, and more than likely it's going to be longer than the 25 years listed. So thanks to Milestone Advisory, I'll just give you a quick run through on their slide. If I was to give you the background on the figures in this slide, I'd be here for another 50 minutes and Darren would not be happy with me. So just to summarise briefly, a couple can receive an income in retirement, private income of €13,000 per annum without any tax implications. So that's what you could get tax-free. To provide that kind of income, you're looking at a pot of €518,000. So quite a large amount of savings required. On the plus side of it, you will get a tax-free lump sum of $129,500. Quite a nice lump sum and quite a good incentive. And after you invest the money in the AMRF and ARF, an income of $13,000. Again, I don't want to go into too much detail, but if you look down to the end here, the cost of saving over 40 years, and realistically that's how long most people will be saving for their retirement, is £334 a month, or €200 net after tax relief of 40%. So a little bit closer to the cost of our latte habit. Our latte habit could also be our bottle of beer habit, our Guinness habit, our glass of wine habit, our lotto investment habit. You know, there could be a lot of things that we could think could save us that little amount if we put it by every month. And again, as I say, the tax incentives are huge. So the final slide, why invest in pensions? And I would state for employers, they are a tax efficient way for employers to reward their employees. And what we are seeing at the moment is a good way of retaining current staff and attracting new employees. And that's what a lot of our employers that contribute to the scheme would see their pension benefits are. Why would you invest in a pension scheme? The tax relief, number one. You get tax-free growth. Another point, that when that money is invested, if your money is invested in the bank at the moment, any interest you get, which is probably negligible, is taxed. Growth in pension schemes is tax-free. You will get a tax-free lump sum at retirement, flexibility over retirement options, the current state pension at $233, and finally, in case this is your banker, the lotto have changed the odds. It used to be 8 million to 1 chance of winning the Irish lotto. It's now 11 million to 1. So if that's your banker for retirement, I'm afraid they're making that even more difficult for you. So that's me done. Darren tells me my time is up, so I have no time for questions. However, we are at stand 65, so if you want to come over and talk to anybody from CPAS, do come over and say hello. Thank you.